Hi guys, my name is James Bordelous. This is the start of a teaching series I decided to put together. I'm in second year in commerce, and I felt that there wasn't really a good resource for us to help work through our textbooks. So this is going to be an attempt to summarize the majority of the textbook, going chapter by chapter in a few minutes at a time. So this is going to be an attempt to go through basically all of chapter 1 between 5 and 10 minutes, and then I'm going to work through all the chapters. So chapter 1 is just a brief overview of just some finance basics, debt, equity, capital expenditure, capital stock, that type of stuff. And we're going to, I'm going to walk you through that at a really upper level, and then we're going to get into nitty gritty stuff. So we're going to move into bonds and share valuing in the next one. So if you know your basic stuff, if you think you have a good idea of it, you can skip this video, or you can just take a quick glance over just to make sure you got everything. So this is starting from chapter 1. It starts off by talking about the different ways of looking at your company, and it breaks it down. And the first way of looking at it that they mention is the balance sheet way. So looking at your balance sheets, this is your assets, this is your owner's equity and liability. So your assets are broken down into two parts: current and long-term. And your owner's equity is broken down similarly into short-term, owner's equity, I mean debt, short-term debt, long-term debt, and then we have shares, so equity. To do a few quick definitions, anything that's considered current is on your balance sheet for less than a year. So current assets are things like inventory, things like cash, things that you're going to be continuously replacing over the course of the year. Long-term debt is, long-term assets are things that are like vehicles, equipment, anything that stays on your balance sheet. Brands are also considered long-term assets. So for example, Coca-Cola has a long-term asset for their brand. Short-term debt is any debt that you have to pay back within a year. Long-term debt is longer-term debt, obviously greater than a year, so these are the type of your loans. Short-term debt might be things like bonds, if you have one-year bonds. Equity is ownership of a company, so you can sell parts of your company, little pieces of your company, and then collectively a whole bunch of people own little pieces of the company. So equity is just like a piece of your company, that's your shares. So the next big thing that they mention is working capital. Which is simply current assets minus current liabilities. Current liabilities are your short-term debt. This is your current liabilities, this is your current assets. All that's saying is basically, this is like your cash flow. This is how much money you're going to need to keep your business continuously running. Because if your current assets, like your cash and your inventory, you have less of that than the amount of money that you owe within the year, that means you're not going to be able to generate enough cash, like actual physical money, to keep your company alive. So that's the idea of working capital. So we're going to talk about working capital a little bit later. There are three main things that finance looks at. So we look at working capital, basically like how we're going to manage our current positions, what's money now versus money later, and what does it have implications on the company. The second thing it looks at is capital structure. I hope I'm writing large enough. Maybe I'll start writing a little bit bigger so everyone can read that. I hope you guys can read that from the camera. So your capital structure is like looking at debt versus equity. So this is basically financing your company. So if your company is growing, it needs to expand, you need money for this, there's really only two options. You can either take on debt, whether it be through bonds. Bonds are basically when you have to give a promise to a person to pay them a certain fixed amount of income. It's It's basically like a loan, except you're paying it back in little payments rather than one big lump sum. So that's kind of what bonds are. Debt's broken down into your bonds and your loans for the most part in this course. Equity is your shares, so you either have the choice of telling someone you're going to take money from them now and pay them back more later, so that's your interest, or you have the option of equity, which is the option of selling off little pieces of your company to raise money. So that's capital structure. So it talks about working capital, managing that, capital structure, and the last thing we talk about is capital expenditures. And your capital expenditures are basically things like whether or not we invest in a project. So that's really, really sketchy writing. Oh, sorry about that. Your capital expenditure is basically, does this, we're offered to take on a new investment. It's gonna we have to put out this much money to start it right now, and it's gonna pay this much in the future. Is this worth it for us? So that's one thing that we're gonna get into when we talk about chapter 4 moving forward. So we're talking about capital expenditure, capital structure, working capital. Basically, anyone who offers us debts, so anyone who's willing to lend us money is considered a creditor. That creditor, yeah. I just want to make sure you just remember that word. It's a little buzzword. The way we value a firm is the total value of their, the value of the firm equals the debts plus the equity. So the debts plus it's equity, but we use the letter S for shares, which makes sense because it's saying the amount of money we have in our business is equal to the amount of money that we've raised plus the amount of money that we've raised through borrowing, and the amount of money that we've raised through selling off little pieces of our company. So this is the value of our firm from the point of raising capital, not so much in the point of what it's actually we're able to do, because we're going to take all this money, invest it, and then we're going to, in assets, long-term assets usually, or current assets, use that to do our business operations, make money, and start paying back these people. So that's the idea of our business. So these three things that we talked about: working capital, capital structure, capital expenditure. These are the jobs of the treasurer. So there's two main jobs in managing money in a business. We have, I just want to make sure we get this right. At the very top, we have the board of directors who hire a CEO, who hires, so there's a CEO, then below him is a COO. CEO is Chief Executive Officer, COO is a Chief Operations Officer, and then below the CEO it branches down into two people. We have our treasurer and our controller. Now these are ones that are often mixed up by people who don't know exactly what they are. Controller handles all the your stuff with accounting. So this is like all your stuff, like your taxes, your cost accounting. So that's your managerial accounting, and financial accounting. So doing your balance sheets, income statements, cash flow statements, and it says also in the book they talk about they handle IS, so your information systems. That I think is debatable, but so think of your controllers as your accountants, and the way I remember it is people who control are anal. Accountants, I don't know if you want to make that reference, but my point of view is I can never be an accountant because I'm not anal enough. I'm not super crazy about numbers and can sit down and do number crunching. So that's how I remember it. The controllers are anal, so I can't be an accountant. The treasurer are the people who work with the money. So treasurer, money, these are the people who are gonna take the treasure and then invest it. So these are the people who are talking about the finance side, right? And so we talked about these three things before that finance is all about. These are the things that the treasurers are doing. So these are the people who are handling our cash flows, who are working capital. These are people who are analyzing our capital expenditures, deciding whether or not we're going to invest in projects. And these are also people who are talking about capital structure, choosing what's the optimal, how much debt we should take on versus how much equity we should take on to keep our company going and expanding. One thing we didn't mention here that they also do is they talk about financing plans. So this kind of works into capital expenditure. They choose where we're going to be putting our money. Let's start talking about the three major things that we go over in the first chapter. I hope this is pretty clear. Treasurer, think treasurer, people who handle our treasury. These are our finance people. Controller, anal, these are accountant people. So this is what we're going to be talking about. I'm just about to circle it. Our treasurers are the people that we're worried about for the sake of finance rather. I circled that and then just erased it. Moving forward, I think we're doing okay for time. We're almost about halfway-ish. Financing a company. I hope we're about halfway. Financing a company, this is where we're raising money for expansion. So this is the kind of idea of this one here. So when we're financing a company, we're looking at debt versus equity. So the first step is we sell debt or equity. So one thing on this note is that